It solidifies that ecosystem as the center of risk taking and experimentation. You already kind of saw that with DeFi and meme coin trading generally, but to see such a big public figure kind of bless the chain and effectively put that wallet in so many thousand more people's hands, like I think it says a lot.
Today's show is powered by SKALE. We'll hear more about them later, but first, let's dive into today's episode.
Nothing said on 0x Research is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and any views expressed by anyone on the show are solely our opinions, not financial advice. Boccaccio, Ryan, and our guests may hold positions in the companies, funds, or projects discussed.
Hey guys, welcome back to another episode of OX Research. Today I'm joined by Carlos, Ryan Cashflows Connor, and Daniel Shapiro from the research team. Great to have you guys on. I want to start off the conversation before we get into anything else. Crypto's had a bit of a crazy last week and weekend. Some crypto related, some not crypto related or tangentially related maybe. Over the weekend, we saw some crazy things around AI models, the DeepSeek model and team coming out of China, and the subsequent reaction to crypto prices and stock prices on Monday. So I'm curious, takeaways, thoughts from that sort of crazy volatility event that we just experienced off of like basically one kind of core event or piece of news.
Yeah, I can start this. I don't like to be, I don't want to say like, I hate to use the word stupid, but it is the stupidest market sell off that I've ever seen in my career. Um, Usually, like, as much as markets are inefficient, like at the end of the day, nothing is perfectly priced in. They're way more efficient than this, right? Like, they're performing very poorly in the face of new information. Um, a few things about what sparked the sell-off. It was DeepSeek. It gave AI ROI bears something to cheer about, which is strange, and we'll get into that in a bit. Um, and it made people question kind of like the profitability of AI infra going forward. And for some reason, that sparked a major market sell-off. Just first on the logic of it, like, I think it was extraordinarily stupid. Like, why? Like, so China, so both the Chinese government and public institutions coming out of China have a long history of lying, both about just simply audited financials and then technological capabilities. From like a macroeconomic data perspective, China overstates its GDP by about 2.5x. We know that from satellite imagery. New York Times did a great story on a study on this. Um, China is the only economy in the history of the world where everyone else's GDP year over year oscillates like this. China's was a flat 6-7% for about a decade. Um, since Xi has been in charge in China, they've decreased the macroeconomic data output, so publicly available data to the markets, by 80%. And the list of corporate scandals coming out of China, like Luke and Coffee, Sino Forest, Rhino International, KDX, QTT, all of these guys, like, and it's not even like they had aggressive accounting practices, like they lied about their revenue, right? Just probably 18 months ago, it came out that China was working on a chip that was something like 100 times more powerful than an NVIDIA chip, and probably was true. And NVIDIA could make that chip tomorrow, but the problem is you can't produce it, right? So, like, you can say you have all the technological capabilities in the world, like, you need to be able to produce it at scale at a yield of 80% or better for semiconductors. So a lot of nonsense comes out from official comms from China. DeepSeek is no different. There's no way that this model was trained using like $5 million worth of GPUs. And we know from public comments that they have 50,000 H100s, right? So, like, they did not achieve some massive scalability breakthrough in terms of training. On the inference side, it's much more believable. Um, and and it's clear because the model is open source, right? So you can run the tests. So they have achieved something on the inference side. And that's great for ROIs. Like, Sequoia has kind of led this charge of like there's too much chip build out, AI is too computationally intensive, the ROI is not going to be there. AI bears like came out in full force saying like, see, the ROI isn't here. What are you talking about? The cost of AI inference just declined. The opportunity set is the same. The ROI is increasing, right? So like I don't think that the market could have handled this like worse. Um it's one of the silliest sell-offs that I've seen in my professional career, and given everything that's going on with deregulation in the United States, AI at the mega cap tech firms, and like the green light on crypto, like I see us coming, like we're going to be higher. Like it's kind of it's very obvious to me.
Yeah, I guess unfortunately for our industry, Bitcoin and other assets kind of took the brunt of the sort of bear pricing over the weekend or volatility prior to or going into the market open on Monday. So it was unfortunate for everyone on the weekend freaking out about, well, what the heck is DeepSeek? Have you tried it? I haven't used it. I don't even understand what's going on. A lot of reactions like that were going on. I think that reflect the sentiment that Ryan says around it being a bit stupid. It's probably a fair take. That said, there were other things that happened last week, pretty monumental for crypto, or at least looking like they're shaping up to be. We started off with, and let me share this, an official executive order from the new standing President Trump related to strengthening American leadership in digital financial technology. So we got a sort of initial conversation starter executive order related to crypto is maybe how I would term it. Some of the things discussed are really sort of setting a 180 from the prior administration, where previous executive orders that sort of set the tone for how regulators should think about crypto have either been rescinded or reversed, and so now it's looking like more of a positive approach to handling these things. Some of the examples from that include in the previous Joe Biden administration executive order had specific and clear focuses on consumer protection, financial stability, CBDC development, illicit finance prevention, and international coordination. So it was very clear there was a very negative sentiment in regards to the industry at that time, and this was about sort of preventing illegal activities or proper handling of other illicit activities, making sure consumers were safe and protected. Like I mentioned, basically a 180. I guess I'm curious, there's a lot of potential downstream sort of impacts from this. Is it establishes a working group. And I think really the big question is like, where do we go from here? Nothing has really happened yet. This is just setting the tone. What are some of the downstream impacts, like first, second, third order, that we're thinking about that are coming?
I think like first order is like stable coins. That was very clear to me. Like when you go through the purposes of the executive order, you see like promoting and protecting the sovereignty of the United States dollar. They also have a very anti CBDC stance. And so I just think one of the second order effects is going to be accelerating stablecoin adoption. And I think one of the winners here is clearly Circle. Like over the past month, like USDC supply is up about 20% to 52 billion. These are levels not seen since August 2022. Like you see USDC supply in Solana is up more than 2x in the past month. uh, I think it's going to be very bullish for Circle and for USDC adoption over the next 4 years, let's just say. And I think it can help like create innovation around like on-chain bank accounts and this type of stuff that are very exciting and that can help like onboard millions of users on chain. Like for instance, I don't know if you have seen like this Fuse development with their smart wallet, where they have like a virtual bank account and like you can send an ACH just as you would for a normal bank, but it converts automatically to stable coins. I think we're going to see developments like this on a more massive scale.
Yeah, those are excellent points. I think one of the things from it that caught my eye was the potential for a national digital asset stockpile, and so already, right. I think the order, by effectively giving the green light to TradFi to come into crypto, right? Like I think the next logical step is right, like them coming to like buy our assets, right? Like whether that's through ETFs or other vehicles. I think what the stockpile could do is I think that could start to accelerate, uh, I guess, like various ETFs and kind of give, you know, the okay of like, all right, like these are good assets, right? Like these are protocols or tokens or whatever that, and I mean, hopefully Ripple will probably be in there. So, you know, not all of them, but I mean, you know, they've had some pretty positive developments recently, but I think that giving that kind of stamp of approval, I think opens the door also for like more experimentation, right? So like, I think the ETH ETF has been underwhelming. You know, if there's more ETFs, like a Solana one might be next. We don't want that to be underwhelming. We want people to understand these assets, to buy them, to be able to experiment with the applications on them. And so I think it's all kind of related, but if the government itself starts stockpiling specific cryptos or starts buying specific cryptos, obviously like Bitcoin is the obvious one. I think that would really accelerate adoption rapidly.
Yeah, like gives a green light to a lot of institutions. I still speak with my buddies in TradFi quite a bit, and you know, they're still on BTC. And the reason that they're on BTC is because the government's given it a blessing and they feel like they've been left out. Like if ETH is very weird to them still, despite the ETF, it's still quite weird. Um, Solana a little less weird, I think, just because of it's like a little bit more venture oriented, and ETH is a little bit more cypherpunk oriented. So like it's strange, but yeah, I think you know if there is some sort of reserve or basket of crypto assets, oh my god, like who had that on their bingo card this year? Like not like no one, zero people, zero people. Um, I think the pretty interesting thing about the stables, the potential for stables in 2025 or maybe early 26, is um, like big cap tech stepping into banking. I remember like, geez, it was like 15 years ago, like Walmart tried to get into banking and the government basically just didn't let them. And they had, you know, you have a lot of dollars flowing through your system. You might as well try to financialize it some way. Um, Facebook tried to with DM, Apple flipped a switch on their phone and, you know, Apple Pay is running at, I think, a $4 billion run rate. The Google Wallet is an experiment in that direction, and like they've been tiptoeing because governments would not let them. Um, Perhaps this move to stablecoins it just makes it so much closer to the tech, right? I think that they could get a wedge in there because no one wants to go. You know, it's not it's not a good experience having Bank of America or J.P. Morgan as your bank. The UX is still terrible. The websites work so awfully. Like they're just so behind. They just have like a very Web one like view of a financial infra. So like I don't know, it's pretty interesting where Twitter, TikTok, um, Facebook, Meta are all making payments out to creators. Like if they were to get enough of a green light from regulators, why not issue stables that they take 100% net interest margin? I don't know. It seems a little crazy, but I think that what we're seeing with the regulatory environment, like you have to be thinking about these crazy things and these tail outcomes.
This episode is sponsored by SKALE. SKALE has differentiated itself from other layer ones by offering users a network of gas-free, interoperable EVML ones where the user experience comes first. Explore the gas-free ecosystem at scale.space/ecosystem and follow their journey on X at SKALE Network. To learn more about the gas-free architecture and growth of the SKALE ecosystem, visit the SKALE Research Hub at scale.space/research. Yeah, I think you make a good point on the social platforms, and I'll even add the other side of that equation is that they're also handling like payment in from, you know, subscribers, followers to their favorite channels or platforms. So taking those revenues in terms of tips and fees and sub fees, et cetera, and then also paying them out right to their creators. And yeah, I think you make a great point there. Maybe related to this point is another sort of item that got handled recently was SAB 121 was also rescinded as sort of part of this kind of list of quick acts by the Trump admin. And replaced with a new SAB 122. I think basically the idea here was essentially another 180, where previously SAB 121 required more stringent records in terms of holding crypto assets as both liabilities and assets on their balance sheets. And so this might open up either simpler ease of offering or reduce compliance costs for existing crypto companies potentially, but also TradFi institutions who maybe would never have touched crypto without sort of putting this ruling out of the way. I think both are interesting, but clearly, we just mentioned how maybe platforms that are not banks today could potentially become more like banks. Maybe this contributes to that point as well, where if you take this additional sort of compliance hurdle out of the way, this opens up potentially things for the Apples, the Googles, but it might also open up things for the JPMs, the other banks standing today. Thoughts here?
Yeah, I think the ability of banks to custody Bitcoin can create very important second order effects. I think one of the most important use cases would be to have a functioning credit market for Bitcoin. I think today there is a very large demand in the market for using just Bitcoin as collateral and borrowing against it, like, I don't know, to buy a house or buy a car or whatever. And today, the options that you have, like the most liquid options in the market, are just like protocols like Aave, where you have to use a wrapped version of Bitcoin and borrow stables against it. And then those stables, you have to kind of like off ramp it into US dollars and then like spend it any way you want. Whereas if you have like a bank that custodies Bitcoin and allows you to borrow against it, is like a much more efficient process. And I think like a functioning credit market with banks accepting Bitcoin as collateral could be one of the crucial catalysts for expanding like Bitcoin's usability worldwide, or in the US at least.
I think this is also going to like in an interesting way impact companies like Coinbase itself, right? Because Coinbase has such a head start on the crypto side. It's like, why couldn't they be a bank themselves, right? And like maybe Coinbase issues their own stable coin. I mean, obviously they have a partnership with Circle to some degree, but right, I think ultimately the banks that don't evolve are going to die. And the new age ones, I mean, why can't every bank issue their own stable coin, right, against their own assets? And I think um, that's going to kind of be the future here. Like, obviously, Trump in the executive order kind of outlawed CBDCs. So I think you're just going to see increasing competition for stable coins. And I think like banks are like a prime candidate to issue their own stable coins.
Yeah, it's they're definitely going to want to. The UX is going to be so bad though. Um, Maybe there's some opportunity for some clearing, like institution or some group effort on stables, because the friction associated with going in and out of different stables is such a pain in the ass. Maybe only a small portion of consumers end up doing that, but like, I don't know, there's this complexity issue, and like everyone just wants to own one stable, right? Like seeing USDT, USDC, whatever else is there, die in your wallet. It's like, why can't this just be one line item? I honestly thought that we'd be there by now, that there would be some, like if you asked me 2, 3 years ago, I thought that there would be some solution. Not there yet. Maybe this green lights. Yeah, maybe this catalyzes it. Who knows?
Yeah, I'll agree on the points, sort of maybe supporting platforms like Coinbase, maybe even Robinhood as well going forward. I think like they're clearly the most well positioned today in terms of offering a variety of services. Having crypto asset trading, having stable coins. You look at Robinhood and having the connection between TradFi markets, crypto markets, regular bank deposits. If you tack on, the potential for stable coins there as well. Um, I think, these platforms have gone beyond the hurdles that Ryan is mentioning of, crappy UX and like old banking, slow applications. So definitely from the kind of the viewpoint today, it seems like they're most well positioned to sort of continue benefiting from positive legislation in this direction.
I think Twitter just announced an X wallet powered by Visa. Pretty relatable. Allows for secure instant funding of your X wallet, connects to your debit card, allows for P2P payments, and option to instantly transfer funds for your bank account. No mention of crypto though. My bad.
So this is interesting that they partnered with Visa, it looks like.
Yeah, XMoney.
Sorry, we're learning this real time live, but very relevant. Definitely interesting though. I mean, going back to what you said earlier, like this plays right into that point. Like these social platforms, there's a lot of money flowing through them, getting wallets, getting payments really locked in here, and essentially like banking services seemed like a clear next step for them. And it seems like they're maybe taking those steps. I'm curious on your guys' thoughts here, like their decision to work specifically with Visa here. How do we think about that, and then the potential for them to like integrate stablecoins, crypto payments, other things maybe down the line? Do you work via through and via Visa as maybe they kind of onboard crypto services, or is this opening up the potential for them to kind of onboard other partners like a Circle or a Coinbase or other platform for handling different types of payments?
I think the competitive dynamics are so weird. Like Visa's clearly at this point in time with these rails are like so commoditized. Given what crypto can offer, I think it's just kind of like maybe missing the scale and the legal backing, but like Visa's purely just extractive, right? They take like some non-zero amount up to 2% per transaction. Um, you have to think that Elon hates partnering with Visa on this, right? Like he vertically integrated SpaceX for a reason and like did something very close at Tesla for a similar reason. Like, I don't know. I think it says that, the payment tooling is probably more ingrained than we'd like. Um, I don't know. Maybe it changes in 18 months.
Maybe an interesting line from this tweet that I'll just highlight is that the tweet specifically says Visa is our first partner for the XMoney account. So it does give me feeling that maybe they're looking to open that up to multiple partners going forward and have optionality here.
And I guess something interesting to note is like I do think that interoperability infrastructure, specifically for TradFi, is getting better. In terms of PayPal, or in terms of Visa specifically, like they actually have like a stablecoin dashboard on their website, and so I think that, right, like I wouldn't be surprised if like PayPal like issues a stablecoin themselves. Like I think that that would make a lot of sense to me. They've kind of dove into crypto in various domains. I know they're working with Chainlink, and so yeah, I mean, I would be very surprised if there wasn't some type of like stable coin or like crypto functionality to this wallet.
Yeah, I'm honestly not surprised that they're integrated with Visa. You see this a lot of with neobanks where they just integrate with Visa to have their own debit card. And the reason is you want people to stay on your platform. So, for instance, if X pays a creator X amount, they don't want that creator to off ramp their dollars to another platform. So, if you have like a Visa debit card where you can directly spend that, then you kind of retain your user that way. So I think the Visa integration actually makes a lot of sense to me.
Hey everyone, we'd like to give a special shout out to the sponsors of today's episode, SKALE. SKALE is built different. Unlike other layer ones, SKALE is offering users a network of gas-free, interoperable EVM L1s where user experience comes first. SKALE operates like the AWS infrastructure model where developers pay for space in the network in SKALE tokens to validators. Essentially, SKALE has chain fees and not gas fees. This allows for free transactions on Scale and has saved 46 million users over $9 billion in gas fees. Explore the gas-free ecosystem at scale.space/ecosystem and follow their journey on X at Scale Network. Visit the Scale Research Hub to learn more about the gas-free architecture and growth of the ecosystem. That's scale.space/research. I guess let's continue on from this one. Still maybe on the topic though, somewhat related to Trump at least. The meme coin, I think we've sort of discussed the Trump token a little bit, but prior discussions were really more generally about what it is, or kind of it being sort of a shock to the industry at the time last week. But I think there's sort of a bigger question here that the Trump token kind of symbolizes a shift potentially for what chains, where activity is happening on chain, and what types of things are maybe interesting in the moment, or if we see some different trends that pop up. Obviously, one of the big sort of factors that we saw was Moonshot, which was an official partner of the token, saw like something like 400,000 plus new users onboarded in the 24 hours after the token was launched, which was pretty significant. I think the number of daily active users has declined significantly since then. So it was sort of a one-off, like, yeah, I'll come on and I'll trade the Trump token because that's crazy, that's interesting. But they've not maybe necessarily been retained for the most part, outside of maybe the curious few who stick around. I'm curious your guys' takes. Ryan, I know you have an interesting one around like what other sort of signals this gives, or what other kind of impacts we could see to whether that's the blockchains, or like the types of tokens being traded, the types of games being played on chain, now that we've had sort of like a presidential token that sort of opens it up for anyone.
Yeah, I can start. I mean, there are a few obvious implications. I think, look, the celeb tokens and meme coins have always kind of been a gray area, or at least it was assumed to be. We all knew that they didn't depend on a team in their purest form. If you just issue an arbitrary unit and you give it no roadmap and you give it no plans and you just disappear, like, it's not a security. But it felt a little weird. Now that you've had the president do it, it is a green light for everyone else to do it, so long as they're maintaining compliance with the Howey test. So you've already seen more of these. It's like very, very, very obvious you're going to see more of these. The increase in stablecoin supply, and then what that's going to do to Solana DeFi activity, um, is another obvious kind of first order effect. I think it solidifies that ecosystem as the center of risk taking and experimentation. You already kind of saw that with DeFi and meme coin trading generally, but to see such a big public figure kind of bless the chain and effectively put that wallet in so many thousand more people's hands, like, I think it says a lot. The throughput that it showcased, again, it shows that the chain, like, there were problems, no doubt, but we continue to see the problems get ironed out and fixed on Solana, so like, no worry there. The second order impacts are interesting. There's a lot of, I think, interesting product ideas around meme coins. I think, like, one, like, it helps to think like 3 or 4 like steps down the road when thinking about products here. I like the idea of donation rugs, where we know gamification increases engagement. We know that kind of meme coin trading kind of like ignites this desire of speculative capital to like make a quick buck, knowing that the thing is valueless and will probably go to zero. And we're seeing increasingly celebrities and notable public figures in crypto toy with the idea of creating meme coins, giving a large portion of the supply to some cause or affected individual, and playing that meme coin game and attracting capital and letting the recipient of that large portion of the supply decide when to rug. And I'll play that game all day. Like, it's fun. It's funny when it goes to zero. and you contribute to a good cause, like sign me up. Like who doesn't want to like throw a few shekels at that and see what happens? Why not leverage like this insane like kind of DJing game for like the greater good? You've seen it, I don't know, 5 or 6 times now, and that's like me like passively paying attention to the space. I'm sure I can dig up more examples. Mark Cuban most recently floated the idea of releasing his own celeb coin and giving the proceeds to charity, effectively letting them rug or sell off, a portion of it over time. So I think that that's interesting, and I think it should be its own standalone product because you worry about um, kind of conflicting incentives on the general platforms and like vetting who launches these things. Whereas like a GoFundMe like takes care of that, right? Like they establish a reputation for what they have on their platform, kind of like a clean slate. I think like as a crypto project in like the nonprofit space, or sorry, not the nonprofit space, but like in this like in the like the giving sector, I guess like there's an opportunity there um, for a standalone product, which I think is pretty interesting.
For me, and this isn't necessarily like as much meme coin related. I guess it might be more of like a second level effect. But um, I mean, if Trump is doing this, I think that a lot of TradFi, like regulated financial institutions, I think that this could be an impetus to where they're actually going to start doing stuff like on chain and experimenting on chain in significant ways. And I think that the first sector that could meaningfully see like a sizable TVL increase is DeFi. Um, so things like Aave, a Camino, a Chainlink, kind of your like traditional like DeFi infrastructure, and it probably starts with lending. Um, if just a few basis points of the capital, so like some large asset managers start like whatever, putting some stable coins or some ETH or some Bitcoin or some Solana or whatever into these DeFi applications, like their TVL could go up by multiples. And so I'm not as versed on the meme coin side of things, but I do think that right, this is kind of a like this is a complete 180 from the previous regime, and so to me, like that's where my mind immediately goes in terms of like a downstream impact. And we might not see that for till later this year. Like there's still technical challenges to connecting those ecosystems, but I think that once they are connected, like I think you could see DeFi TVL like literally go into the trillions very rapidly, and that's just once again that's just like a percentage. That's like a few basis points, a percentage point, maybe max, getting allocated to these things.
Yeah, I kind of want to echo Ryan's thoughts on this. Like Trump gave the green light for other celebrities to launch their own meme coins. I think you had David Sachs as well saying like NFTs and meme coins are explicitly collectibles. They're not securities. So it's like just another blessing for everyone to launch their own meme coins. And one thing that I want to ask you guys is, do you see this as a 2021 NFT moment where celebrities get onboarded, they buy their NFTs, or here they launch their own meme coins, and then go fast forward like a year later, 2 years later, and no one buys NFTs? Like, do you think like in 2 years' time we'll see meme coins being launched by celebrities as well, or do you see more like a hype kind of thing, like an ephemeral trend that will eventually die down?
I've got to take here. I think the game will evolve. I don't want to compare it maybe to the cycle basis, but maybe more of like how the attention games have sort of evolved on chain. We've even recently have gone from animal memes and AI memes and different sort of like subsectors within its own category that kind of like get some attention and then die off. And this I think will follow similar sort of trends as just general sort of on-chain trading activity has, where if this is a trend and a bunch of celebrities are going to launch coins, then yeah, I'd agree. Like 12 months down the line. Like that's not going to be the interesting thing anymore. But the game might evolve over those 12 months to where, you know, maybe instead of launching like the Mr. Beast coin, maybe it's like he does a new competition and there's, you know, 12 contestants and every contestant has a token, and you can like bet on which contestant is going to win by buying their meme coin, and like it gets bid up by people watching this competition. And you know, you can sort of play the game around it. I think this really opens up like other games to be played beyond just like the token. It's, you can build up games around them and then like use the tokens to sort of incentivize how people interact and play with the game, which is I think where things will sort of naturally evolve as people kind of like fight for views and attention like they do on traditional social platforms.
Yeah, I think you're right. I think that um, it's interesting what happened in 2021 as a consequence of the pandemic. Like trading as like a cultural phenomenon got a huge installed base as a result of COVID. Like people in my network who had never traded anything, like RSI is known, Bollinger Bands are known, um, chart, cup and handle, wedge, pennant, whatever. Like they know trader lingo. It's not hard to get up to speed on it. It's embedded in like very like male, like gambling oriented circles now, whereas it was not 5 years ago. Um, I think to compare it to the NFT craze, yeah, I've always been short that view. I think when something happens once, it's weird and you can dismiss it. When it comes back, um, stronger, faster than ever, with like serious teams building products around it, like you can't ignore it. There's an installed base for that behavior, and that means that there's people to sell to. And second time around, like if you're a young founder, you like games, you have a new dimension that you can incorporate into a game that you basically weren't allowed to experiment with in the past. So you've like opened this like box of creativity that simply wasn't available before. So I'm pretty bullish on what can be done with putting arbitrary coins into apps. I think it's going to be like, look, is it going to be like an Instagram type app? No. Is it going to make a few $1 billion in market cap? Like, of course.
Good stuff. I'll add one more point on the topic before we jump to something else. But what I think is interesting and what has been more cemented by this event is the decision for Trump to use Moonshot and for other teams to sort of lean into this idea that things are happening on chain. Robinhood has recently integrated with Moonshot as well, kind of following this event, to enable quick onboarding there. And Moonshot themselves is really marketing themselves as like this just easy to use, swap, like download the thing, put some money in with Apple Pay, look at tokens that are funny, buy them. Don't worry about gas fees. Don't worry about anything else. You look at the tokens and you buy them. And that's really the experience that like people who are not in this industry need to have, because when you get into the like the gas fees and the nonce and the transactions and your MetaMask wallet, all that stuff, it's way more complexity than anybody really wants to deal with. And so I think it's really interesting to see this trend kind of continue to shape that more and more things are happening on chain, versus on centralized exchanges, for example. And we've even seen Coinbase recently mention how they want to improve their listing process. They feel like they are missing out on assets, because they're, you know, launching on chain. They're rising up to, you know, incredible market caps. There's lots of trading volume happening on these things. Virtuals is a good example, where they just are not quick enough to respond to listing them on their exchange. And the community sort of is like confused. It's like, why aren't you listing this multi-billion asset that's on base? It doesn't make sense. And this is cementing and contributing and sort of continuing that trend, it seems like.
Yeah. Um, Moonshot is smooth, like very, very smooth app. I'm not sure like what it takes from a dev perspective, like the talent delta that you need to like make an app like that. But I don't know, whoever made that app, like hats off. Like that is it's a very haptics are great. Minimizes clicks, onboarding super smooth, like very, very impressive.
And I guess to segue into another app that I think a lot of people would agree is fairly smooth, nice to use, is Jupiter. They've also had some interesting announcements recently. Their Cats 10 Bull event was over the recent weekend, I believe. And they announced multiple things. One big one was sort of symbolically burning 3 billion of the supply. Some other things like announcing a stake in Moonshot, and some omni-chain plans. I guess, Carlos, I know you grabbed some data on this and you sort of dug in. You want to give us a kind of an overview and what you're thinking?
Yeah, like they had two sort of developments, one for the product and then for the token. Like if you want to get into the product first, they had a majority stake acquisition of Moonshot, and they also acquired the Sonar Watch portfolio tracker. They had a rollout of Jupyter Spot V2, like they renovated their UI, and they also announced an upcoming omni-chain network that's going to go JupeNet, which is basically going to abstract away like the experience of trading on multiple blockchains. I think like the Moonshot acquisition is really interesting, and it's kind of vertically integrating their distribution. Like if you see the Trump token launch, like the primary liquidity venue for that was Meteora, which is part of the Jupyter stack. Of course, it's the same team. So I think we can see this in upcoming months where celebrities choose to launch a Moonshot. Then, of course, Jupyter benefits because the liquidity backend is going to be Meteora, and then they trade like on the backend through their fees, and then they make a lot of money off of it. So I think on the product side, this is really important. And then on the token side, to drive more value to the Jupe governance token. As you mentioned, they burned 3 billion Jupe tokens, which is like 30% of the total supply. And then they also announced that 50% of Jupiter fees will now go toward Jupe buybacks. I don't think people realize like the buyback yield on this. Like I made some napkin math numbers, and it's like 40% annualized. Like here we have like Jupiter weekly fees from both like the spot product or the DEX aggregator and the Perp side, and like Jupiter fees in the past 90 days have amounted to like 375 million. Like a little bit, half of that, a little bit more, I estimate to be from swap fees. I am like in this methodology, I am assuming like a 5 basis point take rate on the DEX aggregator side. Like there's not a lot of reliable data on this, but you can kind of estimate based on some of the numbers that the Jupe documentation has. Like for instance, they charge 10 basis points on the DCA product. They charge 5 basis points on most swaps. Although some swaps are free, like stablecoin to stablecoin. So I'm just like taking this 5 basis point approach, and then the purse fees are really very large as well. And so if you take this uh, and you assume a price of like $1 per Jupe, like Jupiter could like accumulate 40% of the total supply in 1 year, like with these buybacks, which is absolutely insane. I think the Jupiter token has rallied like 20% since then, but like I think it's really bullish for the market structure of the Jupe token. I don't know what you guys think.
Does that seem to be a misallocation of capital? Such a large buyback yield? Like, why would you do that?
Yeah, I kind of agree with that. It's an interesting discussion of like early in your life cycle, you kind of want to reinvest your profits instead of just like giving out staking yield or investing it all into buybacks. But I think I don't know, right? But my intuition is that they're taking some inspiration from the Radium uh, buyback program. Like Radium also buys back Ray tokens from a portion of their revenue. And it has been really beneficial for the performance of the Ray token over the past 12 months. Like Radium has accumulated like I think like 20% of the Ray supply since the start of the buyback program. And I think like Jupiter wants to kind of achieve something similar. Like we've seen some criticism in the community, like useless governance tokens and whatnot, and like people demand like value to the token even if they don't actively contribute to the product, which I think it's misplaced. Like allegation, but like Jupiter is kind of like alleviating these concerns and trying to create like positive uh, price dynamics. I think.
Can they, once they've bought back the tokens, they just go to Jupiter's treasury, correct? So like they could theoretically do anything with those tokens. Like they could convert them to stables, hold them, um, allocate that to other stuff. It's almost like they're just choosing to. They're almost betting on themselves in a way. Like they're storing fees in their own native token, I guess, in their treasury.
Yeah, yeah. I kind of view it as a stock buyback in TradFi, where a corporation buys their own stock, you kind of just remove that from circulation, and at the same time, it just adds buying pressure to the token, right? Because if previously X amount of people was buying the Jupe token, now you can add like just this constant buying pressure that's coming from the fees to the token. Whereas on the sell side, you don't really have that incremental like like sell offer. So I think it's just like positive for the market structure. I don't think that Jupiter would like implement this buyback program just to sell Jupe tokens. That wouldn't make any sense. Otherwise, just keep the revenue, right? Don't buy back the token.
Yeah, you're right. You're at that point you're incurring slippage two ways and trading fees two ways to do that. So yeah, I guess it's figuring out like what's the ideal percentage of the buybacks. Yeah, I mean that's crazy. That sounds very that sounds very bullish. And even if it's moved 20% already, that doesn't feel priced in with these type of annualized fees.
It's already it's like 2025 is like already rapidly like vindicating two theses, I believe, from our 2025 thesis report, which is just like multi-product DeFi is going to beat out single product DeFi. And pretty obvious there. Traditional financial institutions, you cross sell services because the money's there and money does more than one thing. And for years, it's been pretty odd to watch crypto just like stay in like a very or DeFi teams stay in a very narrow vertical. So it's you know Jupiter and many other teams are attempting to execute on that vision. Jupiter's probably one of the best, and it's super interesting. This is going. I think it happens this year, but like these are growth equity investments. Like you're going to see a growth equity shop own a token like this because it looks like an astounding, like it looks like a fantastic growth equity investment. You have massive year over year growth. You have a sizable market cap. It has a strong market position. It's been de-risked, high margins. The only thing that's stopping it from being a growth equity investment is that it's not a common stock. It's a token, and the governance structure is different. Um, but like, I I find it really hard to believe that like a growth equity shop, especially that's operating on the bleeding edge, or like has made historical investments in fintech, would just let this opportunity pass them by. This seems like something they need in their portfolio.
Yeah, this definitely very meaningful. And what I actually find interesting here is how large the perp fees percentages as part of like Jupiter's total sort of fee revenues that they're pulling in. I think this sort of begs a question or maybe a conversation around perp dexes. We've talked about them at length, but like Hyperliquid has just really been gaining steam since since people airdrop farmed it for a year and since the token launch, it's gotten more popular. Um, Jupiter perps are interesting because they run so much volume, yet only offer like it's BTC, ETH, Sol. Maybe there's only a few assets even enabled on the platform, and yet regardless, they run process a massive amount of volume through there to warrant pulling in these kinds of fees. Um, I guess for me, it kind of begs the question: like, can they maintain that? Like, we haven't really seen any movement there to start listing a bunch of other assets, like try to compete with sort of like the hyperliquids of the world. Um, what is it going to take to sort of keep or maintain or stay in a leading sort of perp spot going forward?
Yeah, I agree. I agree with you in on that point. I think like if we ask the question of what makes a perps dex successful, to me, like the number one reason is like just rapid listing, like a rapid listing framework, right? Like you want to have tokens on your platform that people actually want to trade. Jupiter right now only has like 3 assets, like BTC, ETH, and Sol. They have like the most market share in Solana by trading volume, right? But like you need to be able to offer more than that if you actually want new users to come into your platform and trade like the trending topic of the trending token of the day, right? Like Hyperliquid, I think took like 2 hours or something crazy to list the Trump token. And I think like this kind of like quickness to list new assets is what's making, like, it's obviously not the only reason, but it's one of the main reasons that Hyperliquid has been so successful. And yeah, like you can see this chart here, like Hyperliquid right now registers like almost 5 times more trading volume than all of Solana's Perps protocols combined, which is a crazy statistic.
Yeah, I think, and to tack on to Carlos and get to the question of like what will give a perp staying power. Obviously, like volume is the game, or liquidity is the game entirely, because um, that's what gives end users tighter spreads, and best execution, right? I think the other thing Hyperliquid got right was their order book model, and their market making vault to kind of intelligently um, add liquidity to the most popular pairs. So as they listed, fresh new pairs that people want to trade, they provision liquidity on those quickly and efficiently, and that's super important. I think that um, I think it's going to kind of be like whack-a-mole. Like I think on-chain perps are going to face increasing competition from centralized exchanges. Now with the, as we talked about earlier, all the deregulation with Trump, um, like for instance, like if Coinbase had, like they're building out their derivatives platform, it's coming along, right? I can go in, I can look at it. I just get a gray bar at the top of the screen that says I can't use it because I'm in the US. And as soon as that goes away, right, the question is how many users are just going to stay on centralized trusted options with even, potentially more liquidity and better execution, versus venture on chain. My intuition is that on chain there's going to be a power law distribution, and I mean you're literally seeing that right now, right? Like Hyperliquid has the most, and then you see a decreasing long tail, following a exponential decaying function, down the line. And I think that whatever the leader is, right, they're the way they have edge over centralized exchanges is they're listing assets before, and centralized exchanges are, and they're listing kind of the most, experimental far tail assets, right, first. And so I think that in the on-chain perps land, I think that completely agree with Carlos. Like that's going to be the winner. The winners is it's all around. Obviously, you need sufficient liquidity, but then it's going to be all around, assets and listings.
Yeah, like on the topic of liquidity, there are some like technical limitations on the Solana L1 that prevent like liquidity providers and market makers from offering very tight spreads, and like it's really challenging from a technical point of view to provide liquidity to a fully on-chain order book. Like some of these technical limitations are, one, like suboptimal latency. Like if you look at Solana today, like yes, it's one of the most performant blockchains. Like it has 400 millisecond block times, but like you look at a SEX like Binance and you see like it has latency of like even as low as 5 milliseconds. So like even the most performant blockchains today like don't even come close to the performance that you see on centralized exchanges. And like if you look at Perps dexes, the majority of the volume, like if not today, gradually it will be from high frequency trading firms. And these trading firms like need as low latency as possible, like to take advantage of like fleeting market opportunities. So I think like one, like there's issues around latency that blockchains need to solve like today, like to be able to be more attractive for these high frequency traders than like their centralized counterparts, like even Hyperliquid, like I think it has like 200 millisecond block times. Like, yes, it's really fast. Like I saw a statistic the other day, like the blink of an eye is like 150 milliseconds. So like for a human, this is like, it doesn't make a difference if it's like 200 milliseconds, 400 milliseconds, but like for bots running these arbitrage opportunities, it is very, very significant. The other thing, like for the Solana L1, is just like the congestion issues that have been in the past. Like if like around April of this year, like congestion was really bad on the Solana blockchain. Like I think like transaction revert rates at some point got to like 70%, which was crazy. And one thing I want to make clear here is like this like transaction revert rate was skewed higher by like wallets like with 10,000 or more daily transactions, which these are obviously not humans, right? They are bots, but these are the same bots that are like conducting these kind of arbitrage opportunities. And if you cannot do this profitably, then you're just going to go somewhere else. You're just going to go to a sex, or you're just going to go to Hyperliquid if they offer better like a better trading experience. And like for liquidity providers, this is obviously not great. Like if you want to offer very tight spreads and you don't want to accept like non-toxic, like toxic order flow that like basically makes you lose money. So like it also affects like the liquidity on chain.
A great call out on revert rates. Is that data is on our platform, right?
Yeah.
Yeah, I mean, that's a big part of the story. Dan Smith did a great job with that dashboard. The difference between revert rates for someone who does sub 5 transactions per day and someone who does more than 10,000s per day are completely different. Like that was really lost in the narrative in April and May when Solana was having congestion issues and people were having a tough time landing transactions. Like the bulk of it was due to these bots. Um, Data always helps. More context.
Yeah, so maybe the longer term question for Solana Perps platforms is, timelines to either optimizations of the chain, lower block times, other improvements, higher throughput to enable, basically better latency, increased bandwidth, reduced latency for these types of applications. Though obviously, we're coming down to sort of engineering timelines there from, if it's fire dancer, if it's general improvements to the chain, the core protocols. That's sort of up in the air. And I don't know if like, making your own SVM rollup, et cetera, that may not be the way to go either. Because then you're sort of islanding yourself away from all the liquidity that is on chain today. I don't know. Do you guys have any other thoughts there? Like, at least for Sol Perps, if we take Hyperliquid out of the equation, like, what can be done to sort of challenge? Can anything be done to challenge Jupiter today? These other platforms, they're offering more assets, like more features when it comes to perps, but they can't make a dent. Like, if we look at the numbers, really, I wish we had Zeta on here as well, but it would be a line down there at the bottom as well, relative to Jupe, and it doesn't really seem like they can make a dent.
Yeah, I have strong opinion here. I think that it is. Look, if you look at global financial markets, derivatives volumes are many multiples that of spot volumes. Risk is managed by sophisticated risk managers via derivatives contracts. You don't have sophisticated risk managers in mass on chain today because for the reasons that Carlos pointed out, like it's just like the UX and isn't there to allow them to avoid more sophisticated market participants and do the right thing with spreads. And there's issues of downtime, et cetera. But I think that, and it's going to take a long time. But as institutional capital gets on chain, like the derivatives space is going to completely change. It's up for grabs. Um, it's really up for grabs, and you've seen it historically with crypto perps platforms. Market share changes dramatically, and users are very fleeting, and they are not loyal to their chains. I think there's some evidence that Hyperliquid users are going to be marginally more loyal than historical user bases have been to specific perps products. But since this is an institutional asset class at the end, since these are institutional venues at the end of the day, where that institutional capital comes in is really just going to flip the script on market share. And it's anyone's game. I think it's pretty hard to predict.
Yeah, I kind of find Jupiter's dominance in volume perplexing, to be honest, given that they only offer like three assets to trade. Like one of my theories is like people were incentivized to trade on the Perps product of Jupiter for the Jupori airdrop that happened like 2 weeks ago or like 3 weeks ago. I can't recall. Well, I think some of these activities are probably farming for that airdrop and not like organic.
Yeah, I mean, obviously, like if you ran like, if you just plotted like the daily volumes of like, let's say like the top 250 crypto assets, like that follows a power law distribution as well. So like, you know, Jupiter offers the three largest assets by market cap, right? That all trade the most volume. So um, the volume is that doesn't take me by surprise too much. But in terms of like Jupiter's position specifically, recently, so Radium actually, in terms of spot dex, Radium does like the most trailing 30-day volume, and maybe sometimes Uniswap will be just above it. It might take back the lead, but it's essentially the number one spot dex now, and they integrated Orderly's perpetual futures into its platform, and Orderly offers 80 pairs. And so that's actually pretty interesting, right? Like Jupiter's, just based off like DeFi Llama, like their spot to derivatives volume ratio is like 6-to-1 ish. Um, and that could be wrong. That's based off of DeFi Llama, but like if you follow that same ratio, like if an equivalent amount of volume of Radium went to Orderly, like that would 6x Orderly's volume, and that would actually like put it pretty competitive with Jupiter. So we'll see how that develops, but yeah, as of now, I think it does seem like Jupiter has like a sizable lead, even though it only has those three assets to trade.
I think that's a great call out, Dan, and maybe gets right back into the point around multi-product DeFi, sort of really being a catalyst for, kind of defining some of the key winners right now. And it may be that Jupiter users of their other products that Jupiter offers simply use Jupiter Perps because that's just the one that is easily available to them on that platform. Hard to say that without some concrete data, but it may just lend itself to this thesis, this idea around just offering a great set of products as a multi-product DeFi platform, and driving your users who are swapping and DCAing and doing limit orders, etc. And also, maybe getting some flow into the Perps product as well. If you've got the biggest assets and that's where most of the flow is generally, then you might get a big bump there. I think that was a great chat. I want to wrap up there, but I guess I want to probe you guys for any like last big thoughts. Kind of, if we look ahead 6-12 months, like, we talked about executive orders, we talked about SAB 121, Visa and Twitter, or Visa and X, I should say. Maybe stablecoin and market structure bills are maybe in the pipelines potentially, or even a strategic Bitcoin reserve. Like, what's the core takeaway right now? Like, heading into mid to late 2025 in these markets.
Yeah, just before we get into that, I just have one more thing, like on the
Mhm.
orderly thing that I was thinking about as Daniel was talking, and he's like, no one actually uses the Radium front end. Like all the Radium, like basically are either to say like 90% of the volume that Radium has is like goes through Jupiter. Like, so how are they going to incentivize like these perps volume? And I think that's one of the importance of distribution, right? Because sure, like they have a multi-product DeFi and they now have like a purse volume, but no one actually goes into Radium's front end. Like most of the rate of the volume that Radium generates, like just goes through the Jupyter UI. So I just find that really interesting. It's maybe one of the reasons, or like one of the modes around like Jupyter's volume in the Perps Solana landscape.
That's a great point. And maybe the way Solana perps compete with Hyperliquid is someone makes a perp aggregator, and like if you combine all the Solana perps, all of a sudden it looks a little more competitive to Hyperliquid, and then it starts to pick up momentum, gain more liquidity, right? And reflexively, like you start to see that momentum build. So yeah, maybe it's an aggregator that allows the chain to compete with Hyperliquid.
That was the original Margin 5 business model. When they raised, they were going to do, I think it was like called decentralized prime brokerage, where they were going to be a layer on top of the various trading perps venues. And at the time it was like Mango Markets and I think a derivatives protocol called O1 and then Drift, maybe. There might have been one or two more. Yeah, so that's definitely like a vision. I would like to know why they totally 180'd it. Maybe the chain just wasn't where it should have been, and maybe it's different this time.
I like that. I should have let Carlos go first, because maybe the takeaway is that we need someone to reattempt the perps aggregator for Solana. It sounds like we have a clear business opportunity there, in a market that's up for grabs that either failed or they gave up last time. Maybe the activity just wasn't there at the time, but clearly there's way more things happening on Solana today. Trump has cemented that, like we've said. Thanks so much for coming on, guys, and we will see you all again next week.